So welcome. I am Jennifer Troyer, Dean of the Belk College of Business at UNC Charlotte. Thank you all for being here today, and our apologies for the issue with the Zoom link. We think it's been sent out to everyone at this point, and of course the recording will also be available afterwards for those who miss a bit of it. So welcome to the economic forecast, the UNC Charlotte Belk College economic forecast. So lately there have been a lot of questions after John presents his forecast. So we've saved some time for that at the end of the presentation. And you can submit your questions via the chat function at any time. So over the years, we've been really thankful for our friends in the business community for providing the essential funding necessary to both do the research and to have the event. So sponsors help keep this quarterly event complimentary for our students, our alumni, and the business community. So if you're interested in sponsorship information, you can email us at belk@uncc.edu. For those of you on Twitter, you can join today's conversation by using the hashtag NCForecast. We look forward to seeing your tweets. So now it's my pleasure to welcome my colleague and our speaker today, Dr. John Connaughton. John is the professor of financial economics in the Belk College. John served as director of this economic forecast since 1981, and each quarter he interprets the data and shares his thoughts about both where North Carolina has been in the recent past and then where he thinks will go in the future. Recently, John was elected as a fellow for the Southern Regional Science Association. Over that organization's 60-year history, they've only inducted 32 fellows. So we are really proud of John. Congratulations. And now please join me in welcoming Dr. John Connaughton.
Thank you, Jennifer, and good afternoon to everybody. Here we are for another quarterly outlook, and things have certainly changed dramatically in the last 3 months from what we were talking about in March. And basically, most of it is pretty good news. So let's go ahead and talk about that today. We've got 6 things on our agenda that we're going to talk about. First of all, we're going to talk about the virus winding down and how effective the vaccines have been. We're going to look back one more time at 2020 now that all the data are finally in. We're going to look at the job losses and gains by sector. And I think there's going to be some surprises on the gain side when we take a look at that. And then we're going to do our outlook for 2021, but we're also going to throw in a quick glimpse for 2022 as well. At the end of the talk today, we're going to pick up a couple of topics. One is 1 year of stimulus. How's that gone? And then finally, I think something that everybody is concerned about, and that is, given the CPI last month, is inflation something we need to be concerned about? And we're going to talk about that as well as we go through the presentation today. All right, so the coronavirus. Now, in the past, we've shown you slides about how virulent the disease was, et cetera. Today, it's going to be a little bit different. This is the moving average case in North Carolina. We peaked in January with 8,654 cases a day in January. And as you can see, since then, this has been falling. And when I say falling, I say dramatically falling, bumping along here and even falling some more. So that on May 21st, we had 917 new cases. So cases are down about 89% from the peak in January. And that's pretty significant. To put this in perspective, this is where we were back right after we came out of the lockdown in terms of the number of daily cases. Things have been a lot worse from basically June of last year to June of this year. And it's been a year where it's been up and down, and particularly troublesome around the holidays. As far as 7-day moving average of deaths, on May 21st, we're down to 14 deaths. Again, basically back where we were when we came out of the lockdown, and certainly considerably down from where we were in January, down 86.6% in terms of deaths. So good news is that for North Carolina, big change in the number of cases and deaths. And there's no reason. We've been kind of bouncing along here now for pretty much a month, and I don't think that's going to change anytime soon. All right, so here are state vaccination rates, and I think this is critical. And I think you can see right here that North Carolina is not doing real well in the vaccination. These are fully vaccinated people. We've got 35%. We've got a 9.5% infection rate. So these are people that have had the disease that we know of. There's certainly more that are not on that, that are not logged into that list. So we're probably around 50% folks who are essentially immune in the short term. And that's much less than what we really need to reach herd immunity. So things are better, but they're not where they need to be. And as you can see, some states are in the 50% range. Mostly, well, these are all New England states. The top 5 states are New England. The only one that's not there is New Hampshire. And that's, again, off the list of top 15. So we're not doing real well in terms of vaccinations. We need to step it up. If we look at our vaccination rates, daily numbers of vaccinations, number of doses given out, we peaked in March, pushing out about 100,000 vaccines. Been bounced. These were when we really started to put all of those mass vaccination spots, Bank of America, Motor Speedway, et cetera, drop back down again. And again, since early April, this has been going down considerably to where we're now less than half of our peak vaccinations. This has got nothing to do with supply. If you want a vaccine, hop right in. You can call up and you can probably stop by your pharmacy and get a shot today or tomorrow. We got plenty of vaccine available. We just have limits in terms of the number of people that are willing to go forward and have shots. This is kind of the cases by county, the sum total. And you can see Mecklenburg County had the most, followed by Wake and Guilford. There's no surprise here. This is pretty much population related. What's interesting is the case infection rates. As you can see, we've had some counties, some of the rural counties that have had some incredibly high infection rates. A lot of these are nursing home related infection rates, but still pretty significant in terms of the infection rates. We've had a number of counties that are double-digit rates of infection, where more than 10% of their population has tested positive. What's interesting is that the death rate has come down dramatically in the last 3 or 4 months. So these are cumulative death rates, all right? And for the state, that by county, for the 100 counties, the cumulative death rate runs from 0.5% to 3.2%, some of the bad counties. But as you can see here, there are a number of states that have less than a 1% death rate. And that's 1% of people who are identified as having contacted COVID-19. And you see Mecklenburg County, one of the big counties, along with Durham County and Wake County, all have less than a 1% death rate. To put that in perspective, death rate for seasonal flu is about 0.5%. So for a lot of counties in North Carolina, at this point in time, this thing isn't a whole lot worse than the seasonal flu. State by state experience, how some states done versus some others. Okay, so this was the GDP second quarter declines. We've seen this before, and we can see that some states have had some pretty significant. Now, the numbers that are reported are annualized because that's how we do GDP. When we de-annualize them and essentially say, well, how much did the actual economy drop in the quarter? You can see that a number of states, 10 states, had more than a 10% drop in the size of their economy in the second quarter of 2020. North Carolina, we were not all that bad. We turned out to be 31st in terms of worst drop. So we were, below the halfway mark in terms of the size of our drop, about 8.7%. Through the fourth quarter, which is the last quarter we have data for at the state level, we see that 5 states have actually gotten back to where they were when this all began in the fourth quarter of 2019. So that's pretty good. North Carolina has done real well in that regard. We're not doing good on the vaccine side, but on the economic side, we're doing surprisingly well. We're almost at 99% of where we were before this whole thing began. So we're legitimately doing very, very well. And a number of states are getting back to where they were. And this is very important going forward, as we'll see. Okay, these are the states that have not done so well. And, you've got sort of the usual candidates, if you will. We've got Hawaii, which has really been isolated, relies heavily on tourism. Same with Wyoming. A lot of tourism there, skiing in the winter, and of course, Yellowstone and Glacier National Parks in the summer. Excuse me, Yellowstone and Grand Teton National Parks in the summer. And, those were basically shut down for most of the year. And as far as the rest of the state's concerned, it's a mixture. Nevada is in there, obviously, again, tourism related. And that's where they are. We have a number of states that are, right in the 95% level of recovery. This is the peak unemployment rate, and could have happened in April or May. It depends on the state. And this was their February rate before it went in. And you can see the states, Nevada, Michigan, Hawaii, standard states that you expect to have high rates of unemployment as a result of the lockdown that took place and the travel restrictions. Going forward, however, we now see that we have 5 states that are below 3% rate of unemployment April of this year. We have 12 states that are below 4%. And again, North Carolina is sort of in the middle. We're at 5%. And, we're within 1.5%, 1.4% of where we were when this whole thing began. So things are clearly, for a lot of states, getting better and getting better very quickly. All right, so job losses and gains by sector. You've seen this before, this chart in terms of which sectors got hit the worst. And we're going to go over this quickly because a lot of things to talk about today. But the big sector that was hit was leisure and hospitality and other services. Those leisure and hospitality lost half their jobs, and other services lost about a quarter of their jobs. Most of the rest of the sectors of the economy lost somewhere between 5 and 10% of their jobs. Retail trade was down nationally pretty hard, but not as much in North Carolina. But again, pretty significant declines in construction, retail trade, business and professional services, education and health services, but the big ones were leisure and hospitality and other services. In North Carolina, those 2 sectors, leisure and hospitality and other services, made up over 50% of the total job losses. So about 325,000 of the jobs, of the 615,000 jobs that were lost in April, came from just those 2 sectors. Now, here's the gain, and this is the one that I think is surprising. So we've got, this is total non-farm right here. And so we've got 14 sectors that we track. All right, these are called super sectors. But look at this, of the 14 in North Carolina, 1, 2, 3, 4, 5 have completely recovered. And financial activities are close, they're almost at 100% and 99. So we're looking at pretty close, and the other one, mining and logging at 98.2. We're looking at about half the sectors that are pretty much back to where they were a year ago. And the other half, with the exception of leisure and hospitality, are back within a few percentage points of where they were when this all began in the fourth quarter of 2000, or in this case, February of 2020. Okay. All right, so let's take a look at the unemployment rate and see what's going on here. The blue is this recession. The red is the Great Recession of 2007 through 2009, started in December of 2007 and ran for 18 months. And as you can see, we had a really severe peak rate in North Carolina. Excuse me, the U.S. rate in North Carolina. Try that one more time. Really severe peak U.S. rate. Followed in April, followed by a pretty heavy rate in May of 13.3%, but that's come down steadily. And essentially, 7 months into this thing, we've gone below where the 2007-9 rate was still rising. And you can see we've got essentially till the end of this year and another 7 or 8 months before the 2007 to 2009 recession. Unemployment rate peaked at 10%. We're at 6.1, and we expect this rate to continue to dribble down and probably be in the mid-5 range, pretty close to 5 even by December, when the 2007-9 rate was just peaking at 10%. So, the worst is clearly over for us. We think about where we were at this point back in in the Great Recession, and the worst is still yet to come. So this was clearly, if you look at this thing as an upside down V, this is clearly one of the deep V recovery, if you will. All right, so in 2020, now that all the data are in, let's take a look at what happened. We dropped in the first quarter a little bit, big drop in the second quarter, 31.8% GDP. I got most of that back, 36%, 36.8% growth. Doesn't get back to 31.8% decline because it's base versus base, and the base is higher here than the base is there. So don't get it quite back. And then 5% growth in the fourth quarter. Overall, we had about a 2.5% drop this year in real GDP for the state. That is not inconsistent with the 2007 to 2009 recession. Actually, it was a little bit more in that recession, just a little over 3%. So at the annual level, things weren't quite as bad. This quarter, definitely very bad, but the big jump back got most of that back. On a sector by sector basis, the 15 sectors that we're looking at here, two of them have managed to get growth in 2020. All the rest had declines. The growth was very small in non-durable goods manufacturing and in finance, insurance, and real estate. You can see the big drop was in hospitality and leisure services, about 27% drop, and other services and durable goods were down considerably as well. Those were the sectors hit the hardest for the overall year in terms of decline in GDP by sector. In terms of employment levels, we lost a lot of jobs, but we gained a lot back since then. So for the year, December to December, we're only down 175,000 jobs. Remember, we lost 615,000 jobs, boom, in 1 month. But we've gotten most of those back. And so for the year, we're only down 175,000 jobs. Only one sector, transportation and warehousing. And you can figure out why this one is gone, grown dramatically in terms of warehousing. These are all the folks that are helping deliver those products to your front door this year. And that sector has taken off. Trucking and warehousing has been really, really important during this pandemic and even during the recovery. We lost, jobs were down 3.8% from December to December. And as I say, most sectors were down. The big issue here, as you can see, is hospitality and leisure, which over the year was down 16%. Remember, it dropped 48% just in 1 month. So it's gotten a lot of those back. But here's the thing about hospitality and leisure services. If we look at its percentage that it makes up of GDP, it's only 2.6% of GDP. It's not going to have a big, depression in that sector is not going to have a big impact on GDP, but it makes up almost 10% of employment. When things are going well, it makes up about 11.5% of employment. So not a big impact on GDP, but it's going to have a big impact on jobs. Okay, so it's easier to get the GDP back with this sector struggling than it is to get the jobs back with that sector struggling. Okay, for 2021, things are looking much better. First of all, something that cropped up the other day was consumer confidence for April, and I just kind of want to follow this through. This is the consumer confidence through this recession. Not as bad as it was back in the 2008-9 period when it was down to 25, the index, but it was in the 80s during most of this. And in April, we saw it jump up to 121. These are the levels that are close to the levels of enthusiasm for the economy that we saw back in 17 and 18 when the economy was really go-go. So this is one of the best signs that we've seen in the last year and a half, and that is the consumer confidence is starting to come back. Consumers feel pretty comfortable that the worst is behind them and this thing is going forward. All right, on a quarterly basis or for the annual basis, we expect about 5.3% growth in GDP. That's about double what we've been experiencing over the past 10 years before this pandemic got to us. But you can see that the growth is tapering off as the year goes on. And this is a pattern that we're going to see extend into 2021 as well. 2022 as well. So we're starting to, we had a lot of headroom as a result of the shutdown and trying to get the economy back to where it needed to be and where it should be. So you have got that headroom. Once you close that headroom up, then the growth gets a little bit more difficult to have. And we're going to see that during most of this year. But overall, 5.3%. As far as sector by sector, everyone but mining is going to experience growth. The sectors with the strongest growth in GDP are going to be hospitality and leisure services. They're going to get a lot of it back, not everything back, but they're going to, by the end of the year, they're going to be pretty close to where we were before this all began. Most of the rest of the sectors, educational and health services, business and professional services, those are the strong ones. Durable goods going to pick back up, had a terrible year in 2020, should pick up in 2021 and get back to where they were in the fourth quarter of 2019. Also the same for construction. I see a pickup there as well. As far as jobs are concerned, 199,700 jobs created in 2021. Every sector's got growth except mining. It's a small sector, so it's less than 1/10 of 1% of the economy. So it's pretty stable. And again, those sectors with the biggest growth in jobs are going to be hospitality and leisure and information. Again, not surprising given where we are and the kinds of changes that are taking place in the economy as a result of the COVID lockdown and 2020 experience. All right, unemployment rate. Right now, we're sitting at 5%. The U.S. is sitting at a little over 6%. We expect our rate to be a little bit below 5% by the end of this year, just a tad below by the end of 2021. And it will dip into the 4s either late this year or early next year. And by the end of 2022, we should be back to pretty close to full employment at about 4.5%. Okay, so at the end of 2021, all right, which is only about 7 months away, GDP is actually going to be higher than when this all began. We're going to be about 3.4% higher. So in 2 years, we've gotten a 3.4% growth. That was a bad year in 2020 and a good year in 2021. So, if you kind of split that, average over the 2 years has been a little over 1.5% growth. That's pretty good. We'll have more jobs by the December of 2021 than we had in December of 2019, almost 25,000 more jobs. But the unemployment rate is going to be a little higher. Okay, we think it's about 5%. We're down about 1.5% higher than it was in December. Now, this number is not a long-term sustainable number because the unemployment rate, the benchmark unemployment, the natural unemployment rate in North Carolina is probably between 4 and 4.5%. So we're going to be pretty close to that by the end of 2021, and we should be right in that ballpark by the end of 2022. All right. So let's take a look at what 2022, just one slide here, just get it all there. About a 3.1% growth rate, and you can see it's again tapering off as the year goes on. It's mostly in the 2% range. We're going to get about 126,000 jobs that year, which is a really good job year. But 2022 is kind of the last year where we really expect to see the above 2% growth that we had been experiencing the 10 years prior to the run up to the pandemic. So 2022 is going to seem like a pretty normal year in terms of the way the economy is growing going forward. All right. So what can we expect going forward? Well, consumer confidence is really, really important. One of the things I mentioned in March, the thing that concerned me most now that we started to see the vaccine be available and we started to be able to figure out how to get shots in people's arms. And what we're now, and I was concerned is how fast would people be willing to get back to doing the kinds of things that they did a year ago. And what it looks like now with the consumer confidence number is that people are ready for this to be over, and pending spikes, mutations, and continuing to increase the level of vaccinations, put those two things together. And I think that, going forward, I think that things are probably over, and things are going to get back to normal pretty quickly. There's obviously industries at risk long term. A number of industries still haven't, cruise ships still haven't gotten permission to start going back again. There are still some states that are holding back on opening up certain aspects of their economy. Finally, the one thing that, and we're going to talk a little bit about this, a lot about this a little later, and that's the stimulus check impact and the impact that it's had on the demand side part of the economy. On the supply side, we still have this supply chain shortage issue that keeps popping up. Right now, the two biggest issues that we have is lumber issues, and as a result, the price increase in lumber and what that's done to housing prices, but also on the automotive side. And again, these are two big sectors. When you think about your paycheck at the end of the day, you spend a lot of your money on housing, and probably 50% or pretty close to 40% on housing and automobiles. And right now we're suffering from supply chain shortages in chips. And as a result of that, car factories in this country and in Europe have been rolling shutdowns for a couple of weeks as they try to manage this chip shortage in automobiles. We've also had business failures as a result of this, and the speed at which those businesses begin to open back up or be replaced by new businesses is something that is unknown at this point in time. So these are things that are troubling going forward on the supply side of the economy. Okay, so Congress and stimulus. Boy, they've been busy at work this last year. So let's take a look. First of all, this is an economist's tool, and you really only have to pay to the bold numbers. And that's this one right here and this one right here. What I've done is to take an actual, remember, I de-annualize the GDP numbers so that they're actually the amount of GDP that was produced in that quarter, not at an annualized rate. And so this is a $21 trillion annualized level of GDP in 2019 fourth quarter. But in the quarter, we produced about $4.5 trillion worth of stuff. This is the potential GDP number. And what we've got here starting in quarter one is what we call the gap, the oaken gap between potential GDP and the actual GDP. So we were down $49 billion below what we could have produced if everything was operating. So what I did was I kind of took this for the 2007 and 2009 recession, kind of summed up the quarterly total of open gap and came up with just under $1 trillion. And I did that so far here. And remember, by the end of this year, there's going to be probably no open gap. So we're at about $1.3 trillion. So we're about 30% higher, 35% higher, but these are nominal dollars. So it's actually a little closer than this. So this is really the shortfall in GDP that the recession, and this one, the financial great recession of 2007-9, and this one, the pandemic recession, they're not that far apart. So in terms of the overall decline in GDP, it's not as big as you might have expected because we got back going pretty quickly. All right. And again, we talked about where we are in the unemployment. We've seen this before. So this is just reinforcing that things are not nearly as bad right now as they were at this point in the Great Recession of 2007-9. All right. So in 2008 and 9, after President Obama took office, well, prior to his taking office, in the fall of 2008, we had the Troubled Asset Relief Program, or TARP as everybody remembers it, which was $750 billion. And that was primarily aimed at financial institutions to keep the financial industry from collapsing. By the way, very important bill. And then under the Obama administration, we quickly passed the American Recovery and Reinvestment Act, $787 billion. So it's a total of $1.5 trillion essentially to its stimulus to fight the 2008 to 2007-2009 recession. The interesting part about this is that the U.S. government actually made a $15 billion profit on the $750 billion TARP program. Not everybody paid back, but enough paid back with interest that the government actually made a profit. So at the end of the day, there was only about a $771 or $72 billion stimulus program to combat what we know as the Great Recession. So let's spin ahead a few years. So now we're in this one. So far, we've had 8 bills passed, okay, for a total of $6.1 trillion. Now, not all of that has been spent. Okay, these numbers are authorization. About 5 trillion of this has been spent so far, or is in the process of being spent as we speak. Okay, so you can look at all these. We've talked about all of these before. The latest one was just passed a month or so ago, and that's the American Rescue Plan, and that's the one where really we haven't seen a lot of the spending out of yet. The checks have gone out, but that's about it. Okay. All right. We've also seen a $700 billion round of quantitative easing by the Fed, but a lot of this hasn't actually been accessed to this at this point. But here's the other one. This is the Fed balance sheet. So the Fed balance sheet gotten up to about $4.5 billion. Remember, before the Great Recession, it was less than $1 trillion. And this was QE1, QE2, and then QE3 during the quantitative easing 1, 2, and 3 during the Great Recession. And it got up to about $4.5 trillion. They've been trimming it from January of 2015, basically not selling things off, but letting the debt that they bought, particularly the mortgage-backed securities, just normally go away. And they got it down to $3.7 billion. And then as a result of what they've been buying in the last year or so, they've more than doubled the size of their balance sheet. They've added essentially another $4.2 trillion to their balance sheet in U.S. Treasuries and mortgage-backed securities and some other types of securities as well. Allegedly to keep financial markets operating. We'll leave that to later discussion. So we also have on deck some more spending. Now, this is the American Job Plan, which is kind of a tricky one. The Biden administration put it out 2.3. They've kind of backed down to less than 2 trillion now. The Republicans are putting out a couple of proposals. One proposal that's around $1 trillion. However, this gets passed, the deficit impact is going to be a lot less than the overall, because a lot of this is going to be paid for by either user fees, if you look at the Republican plan, or by new taxes if you look at the Democratic Biden plan. So the deficit impact is not going to be as great. This one here, excuse me, these all here are deficit impactors. There was no way to pay for any of these things other than deficit spending. All right. In addition to that, there's the American Families Plan, which is sitting out there on the horizon, which is 1.8 trillion, and that is, of course, not reduced in any way, shape, or form. So we've got 6 trillion already done. We got looked another 2+ trillion sitting out there, adding to the deficit in 2021. The one thing about the American Families Plan and some of the American Jobs Plan is that these are 10-year scorings, and unlike unlike all of these, which are also 10-year scorings, most of this money was spent in 2020 and 2021. Essentially 5 trillion has been spent so far. These are really looking at over a long period of time, a 10-year frame that these will be out. So these are in the $250 billion a year deficit increases. All right, the Biden plan proposes to raise the corporate tax rate from the 21% that is now to 28%. This is the estimate of the effective U.S. tax rate when you throw in the fact that states also tax corporate income. So across the 51 states, there's another 4 and change percent thrown in on average. And that's where it puts us relative to the rest of the OECD countries, where we went where before on the current law, we're somewhere back below Canada and France, but above Austria, Belgium, and Chile and Spain. This is not a bad place to be. This is obviously number one. This is something that is of concern going forward. All right, so let's take a look at how the jobs have been doing during this recovery. Okay, so we lost a ton of jobs. We got a bunch back once we opened the thing, once the economy opened up, and there's been tapering off. Had a bad December because of the spike. Seemed to be getting back on course. The problem was the April number was a little disheartening. Economists had been thinking it would be closer to 500,000. Now, to put this all in perspective, in a normal economy, a 200 to 250,000 job growth month is good. Period. Let's be clear about that. But we're still trying to replace jobs that were lost as a result of the shutdown. So, somewhere in the May number that comes out, we're hoping that it's going to be north of 400,000, maybe as much as 500,000. We'll see as we get closer and closer to estimating that number. But this was a little disappointing, but I will caution you, 1 month data does not make a trend. So you could have just an aberration, and things could get back to normal in May, when the May number comes out in early June. Okay, there's also been, as we've documented before, a 10 to 20% fraud in terms of some of these programs, where we're sending money overseas to people, unemployment benefits overseas to people who are being able to do two things because of the change in the unemployment law as a result of the COVID stimulus plans. One is they can register and online, and the crush of online registrations, particularly early on in 2020, was such that most state systems simply couldn't handle and didn't do the due diligence. And the second thing is, and this is something that we'll talk about a little bit later, is that they suspended the requirement that you look for jobs. So you could collect unemployment. Normally, you cannot collect unemployment unless you are actively seeking to work, and you can do that online. But you've got to document that. For the past year or so, you've been able to simply collect the unemployment benefit without looking online. All right. So last part of the talk today, we're going to really kind of highlight inflation. And this is something I think people are concerned about. Again, I want to make sure that 1 month doesn't make a trend, but there are things out there. So let's take a look at the types of inflation. Economists categorize inflation into two groups: demand pull and cost push. Demand pull is demand for when output exceeds what the economy can produce. Buyers wind up bidding prices up. And of course, we have stimulus checks currently that are helping buyers bid prices up. On the cost push side, prices are pushed up by increases in costs and availability of the factors of production. I've already documented we've had some lumber shortages in housing, and we've had chip shortages in the automobile production, but we also have work disincentives, which are winding up being cost push because we have disincentives for people to work. To offset those disincentives, we have to increase labor wage rates, and that is a cost push factor, pushing prices up. Now, it is, I think, important right now to kind of take a look back, turn the Wayback Machine, and take a look at the 1970s when this country had a case of hyperinflation like we hadn't seen in decades. We had 3 years in the 70s where we had double-digit rates of inflation: 74, 79, and again in 1980. And every year was above that 2% threshold. Okay. Seriously big inflation during the 1970s. All right, what caused it? Well, let's take a look on the demand pull side. In the mid 1960s, under the Johnson administration, we had a war on poverty and essentially about 15 or more new domestic programs to fight poverty. Things like Medicare, Medicaid, aid to families with dependent children, food stamps, and 12 more programs that were not as big as these, were all instituted in the 1960s that were going to have to be paid for by government financing, essentially deficit spending. In addition, we had the Vietnam War build up in the late 60s, starting in 66, which required a lot of deficit spending and government spending. And then finally, something interesting, and we don't know exactly how much this played, but the United States officially went off the Bretton Woods Conference gold standard in 1971. Classic speech in August of 1971 by Richard Nixon. For those of you that are YouTube fans, you might want to go get the Nixon gold standard speech and take a look at it. It's kind of interesting. So we had all these demand pulling prices up and creating excess demand in the economy. And in addition, we had some energy price availability problems. We had a 73, 74 gas shortage. And again, we had that in the summer of 79. This was a winter problem. This was a summer problem. It did two things. It made it difficult to get around, obviously, but it also affected the cost of production as energy prices were going up to firms. All right. On October 6, 1979, Fed chairman, he'd just been in Fed chair for just a little bit. He decided to take a drastic step, and he essentially switched the Fed policy from targeting interest rates. Now, what's that sound like? How many people are paying attention? That's kind of what we're doing today, right? To targeting the money supply. The days of easy credit turned into the days of very expensive credit as the prime lending rate exceeded 21% quickly after that. And what this raising of interest rates and tightening of the money supply did in a very short term was generate two successive recessions in 1980 and again in 1982. One of the craziest things was that the peak 30-year fixed, yes, that's right, read that right. This is out of the Federal Reserve economic data, stole this chart from them. 30-year fixed mortgage rate average in the United States. Here we are now, 2.5%, right? 18.6% in the early 1980s. Can you imagine buying a house with an 18.6% 30-year fixed mortgage rate? Now, as you can see, it's been coming down ever since, but it basically threw the economy into recession. So let's take a look at where we are now. In the last decade or so, we've been running pretty close to 2%. A couple of years recently was above 2, but 19 and 20 back down below 2%. And certainly in most of the second term of the Obama years, we were in the 2% or less range as far as the annual inflation rate. Now, these are the monthly rates compared to the same month a year ago. And this is for 2020 and then 2021. And you can see we were bumping along here just fine. And then all of a sudden, the rate that got everybody nervous was the 4.2% compared to April of 2020. That was back here, CPI, and the inflation rate of 4.2%. Now, just like I told you back when we were looking at the job growth numbers, 1 month does not make a trend. So this is just 1 month. This could be an aberration, but it has raised concerns, and there are several reasons for that. So let's take a look at those. The federal funds, in April of 28th, the FOMC people met again, the Federal Open Market Committee. They meet every 6 weeks, and they reiterated their target range between 0 and 0.25% for the federal funds rate, essentially zero interest rates. The Fed also said it's going to continue. This is a month ago. We're going to continue to increase its holding of Treasury securities by about 80 billion per month. You do the math, and that's $1 trillion a year. And of agency mortgage-backed securities at 40 billion per month. That's $0.5 trillion a year. Okay, and they make no assessment or mention that this is something that they need to be cautious about. And they say these asset purchases help foster smooth market functioning and accommodate financial conditions, thereby supporting a flow of credit to households and businesses. So that's their stance at their last meeting. The problem is we've got today's inflation pressures. We've got stimulus checks going out. Now, we'll take a look at those in just a minute. Fed interest rate policy, which is still zero money. And we've just done $5 trillion of new debt in 14 months. On the cost push side, we've got housing prices going up at levels we haven't seen in decades. Used auto prices going up, and new regulations, again, causing increased costs on the business side of things, on the supply side of things. So here is almost $1 trillion in stimulus checks, okay, from the 3 sets of checks that have come out in the last year. The American Rescue Plan, Consolidation Appropriations Act, and the CARES Act, which was the first one. Okay, so almost 900 billion, just shy of $1 trillion in stimulus checks. Now, here's the interesting thing about that. Now, bear with me as I go through this. It's kind of, in the weeds, but I think it's important. So when we look at the GDP, national income and product accounts, we get personal income, compensation of employees, wages and salaries. Wages and salaries and compensation of employees are, this is what you get in your paycheck. This is what it costs the employer. This has got all your benefits in it. Personal income is different. That's where you get from all sources other than work. So if we look at Q1, and this is de-annualized, we see the compensation went down by 181 billion, and basically 160 billion wages and salaries went down. But personal income went up by 376 billion. So during the Q2, April, May, June, when we were locked down last year, people had more money to spend than they otherwise would have had to spend as a result of stimulus checks and other programs. And we're seeing that again in Q1 of 2020. We see wages going up. We see compensation going up, but they're going up just slightly, $50 billion here. Again, $40 billion here between Q4 and Q1. Good growth, nothing wrong with that. But we see $500 billion in growth in personal income because of more checks coming out in Q1. And some of those are going to trickle through to the Q2 as well. And it's personal income that people spend from, not wages and salaries and compensation of compensation. So this is what is very troubling on the stimulus check side. Here is a look at the US debt. Before this all started, we had 23.2 trillion. Okay. Right now, at the end of 2020, the last we have this for, it was a 27 trillion. That's a $5 trillion increase. And with the money that's coming out of the American Rescue Plan recent act that was passed, there's another trillion coming on board next quarter, the first quarter of 2021. Okay, now here's the housing prices. This is the US. In the last year, housing prices were up 13%. In the previous 14 years from the trough, housing prices were only up 65%. That's less than 4% a year in terms of housing price increases. Okay. In Charlotte, which is the only city in the Case-Shiller 20 index, we saw again a 4% rise. Last year, 13.5% rise in housing prices. Same thing's going on in Raleigh as well. Same thing's going on in Columbia. They're not one of the major cities in the index. So what we're seeing is housing prices going up by 3 to 4 times the annual rate that we had seen in the intervening recessionary period from 2006-07 up to 2020. Used car prices, this is the Manheim Used Vehicle Value Index. Manheim is the major wholesaler of used cars in the country. They have auctions all over the country, and they're sort of the price guru, if you will, in terms of looking at what's going on in that marketplace. In the last year, used car prices have gone up 54%. And the last 5 months, they've gone up 4 months, 5 months, 4 months, they've gone up 20%. Okay. So going forward, the things for us to pay attention to, COVID-19 spikes and lockdowns, if that crops up again, how we're doing on vaccination dissemination. I mean, we got to get 55, 60% of the population vaccinated to go hand in hand with the percent of people that have been diagnosed as having had COVID and those that had COVID but weren't diagnosed. That'll get us to herd immunity. The May inflation number is going to come out on June 10th, the Consumer Price Index. That's going to have a lot of people nervous and worried about that. Obviously, we need to keep looking at consumer confidence, but I think it's less important right now than it was a few months ago. I think people are, pending anything going on here, I think consumers are back on track to push forward. The U.S. monthly job growth comes out the first Friday. We had a bad number for April. On June 4th, we'll get hopefully a good number for May. The next FOMC meeting is in July. Excuse me, that's June. We'll correct that later. And then the second quarter GDP, that's going to be kind of the big one. That comes out in July of 2020, July 29th of 2021. That we'll see how they are. So we'll see how GDP goes in the second quarter. Now that we've had this big bust out, consumers are happy again. Could be a pretty big number. So we'll see how that looks going forward. So to kind of summarize what we've talked about today. One, the economy is pretty much back on track. The virus is, I think, pretty much behind us. That doesn't mean it's not going to be problematic, but going forward without any kind of bizarre mutants, it's likely to be on a monthly basis kind of what we experienced during the annual flu season. Flu season is only 5-6 months long. This is obviously the COVID thing doesn't slow down as much in the summer as the flu does. But without any spikes or mutations taking place, I think COVID is pretty much over. 2021 is a year of getting everything back that we pretty much lost in 2020. And 2022 is going to be a year that looks like a normal year, like 2019, with something a little in excess of 2%, 2.5% growth, maybe, and getting back to normal in the economy. And by the end of this year, 2021, we should start to be able to figure out whether or not the damage that was done during the lockdown is permanent or temporary. And we start to see some improvement in terms of some of the sectors on the supply chain side. We'll just see how that goes, but we should have a pretty good indication of what that looks like by the end of this year. And by this summer, we'll have a pretty good idea whether or not we've got inflation in our future or not. So that pretty much takes care of the May quarterly forecast, and I'll be happy to answer any questions going forward. Thank you very much.
Thank you, John. So now we're moving to the question and answer portion of the forecast. So we have several questions that we've received so far. And just as a reminder, you can still enter your questions in the chat and we'll answer them time permitting. So we've received some great questions so far. So let me just start with prices, John. So we've gotten some questions about prices of lumber, prices of groceries, prices of steel. Do you see those prices dropping or at least normalizing at any point in the near future?
Okay, this is really, having lived through professionally a double-digit rise in prices over a decade, which a lot of folks haven't had that unfortunate experience. Inflation is a funny animal, and again, I don't want to get way out in front of myself here in terms of, yeah, we had 1 month where the inflation was up 4.2%, and therefore, no. We've got some things underlying that could push us into an inflationary period, but there's not a guarantee. There's not a guarantee that we've got to get a couple of more months of 4 or 5% rate of price increases before we get to that point where we really need to get real concerned. But here's the thing about inflation. If that happens and we start to get it changes consumer expectations. And what consumers tend to do in an inflationary period is start to push forward consumption decisions. And that puts more demand pull pressure on prices. We saw that in the 70s. And a famous old economist, Paul McCracken, of the 60s, used to talk about fighting inflation. He said it was like herding cows. If you run after it, if you run after cows, they just keep running away from you. Well, inflation is the same way. If you run after it, it just keeps running away from you. You've got to get out in front of it and change its direction, which is what Volcker did in October of 1979. And he became a legend, if you will, for taking the incredible making the incredible decision to essentially throw the economy in recession to expunge it of inflation. So that's where we're at. We're not at that point yet. We're not at the point where there is inflationary expectations. But after another 3, 4, 5 months, if we see this continue, then we have a problem. We can solve it quickly now if we stop with the essentially zero interest rates, and we start to realize that the Fed cannot buy up all the debt that's being pushed out there right now, that the market is going to have to absorb it, and the market's going to decide what the interest rates are. But that's probably a discussion for another day. Let's see if we have another couple of months of inflation. Boy, September is going to be interesting, isn't it?
Yes. So we got some other questions about labor. So let me just start with the minimum wage question. So what's your opinion on the push for the $15 minimum wage, and how that might affect inflation? It seems like employers are already moving toward that rate here.
Okay. Two things about the minimum wage. Okay. All the evidence suggests that it is a bigger factor in eliminating or jobs than it is on inflation. Okay. So that's number one. It's going to affect particularly teenage workers heavily, because those are the ones that have low productivity levels. Number two, lots of states are already in the process of implementing this $15 wage. And so the federal minimum wage right now, which is in the $7 range, $7.50, I think, is irrelevant in most states in this country. Third, in most metropolitan areas in this country, we are already way above the market wage is way above the $7.50 minimum wage. It's much closer to $15 than it is to $7.50. So the inflationary impact of raising the minimum wage to $15 at this point in time, I don't think is as big an issue as Fed policy is and congressional spending. Those are the things that concern me a lot more than whether or not we institute a $15 minimum wage. And remember, the minimum wage legislation is not, okay, today it's $15. It is a gradual phase in, as most states have done. Most states and most cities have done a gradual phase in.
So, we have a record number of job openings right now. So what are your thoughts on, how quickly that'll correct itself? We've got a lot of workers still out of the job market right now.
As I mentioned earlier in the presentation, one of the things we did with the enhanced unemployment benefit program early on in this was that, and again, throwing so many people out of work, was that we eliminated the requirement that to continue to collect unemployment insurance, you needed to demonstrate searching for work. Okay, so you could collect unemployment insurance from basically April of last year all the way through to today without having to demonstrate that you are in fact looking for work. And this is going to continue through until September, all right, by federal legislation. But a number of states have dialed that back. They've either reduced the amount of extra money that the Fed had set aside for enhanced benefit, or they've rolled back the requirement that they've reinstituted the requirement that you have to be actively seeking. So a number of states have reduced the benefits, mostly Republican governor states. But North Carolina, for example, we did not reduce the benefit, but we did reinstitute the requirement that you have to look for work. So you can no longer just sit back and do nothing. You've actually got to go out. Now, that doesn't mean you're going to have to take the job if it's offered, but you are out there looking. That's one thing that's hurt the labor supply problem and created a situation where we have more job openings, we have people looking for it. There is a second thing, and that's the big number that the elephant that we don't want to talk about. And that is, we've lost probably 5 million people out of the labor force. They're not looking for work. They're not employed. They went home in April and they still haven't, and they're still not engaged in looking for work or re-entering the labor force. And a lot of that has to do with the fact that kids aren't back in school in a large part of this country. Now, that's all going to end in September. And of course, during the summer, kids aren't in school anyway. So in a lot of areas of the country, so it's not going to be all that much different than it was, say, 2 summers ago. But I think a lot of this is going to end in the fall, over the summer and the fall, when these extended unemployment benefits and the lowered requirements are reduced. We're going to start to see some serious changes in the labor market over this summer as a result of that. And by September, we're going to see a lot of people who've exited the labor force get back in now that their kids are back in school and life's a little bit easier.
So speaking of that, we've got a lot of people talking about remote work right now, and jobs that'll stay remote. So we've talked at the, last time you did the forecast, we speculated a little bit about what was going to go on with commercial real estate, especially, mortgage paybacks, interest rates, things like that, that could impact that whole industry. Do you have any new thoughts on that issue?
Yeah, I think I need to correct where I went back in March. I was a little more receptive to hybrid sort of work for a lot of folks. I'm a little bit less inclined to believe that's going to be the model going forward. I think, I've seen, for example, Chase has basically said, y'all come back now. So I think we're going to start to see a little bit more of that. I think the key thing that has been driving this has been the fact that up until very, very recently, the COVID cases and death levels have been troubling. Even as they've been coming down, they're still more than we usually are willing to tolerate in a flu season. Now we're starting to get into that set of numbers. And as we continue to vaccinate people, as people continue to get the disease, now remember, a lot of the people who are not getting vaccinated are not the people who are dying from COVID. We need to understand that. The vaccination take rate on seniors has been way above 80%, and they were the group that was dying. 4 out of 5 deaths were senior citizens. And they've been the ones that have taken and created essentially in their own age class herd immunity. As far as people in their 30s and 40s and 50s are concerned, they're much less likely to die or get seriously ill from COVID than senior citizens are. And as that data start to roll out and we start to see, yeah, there are a few cases out there, but you know what? Not a whole lot of people are dying. And as a result of that, we'll start to see a much more willingness on the legal side of things for companies to say, yeah, come back, and we don't have to do special things in our landscaped offices for you to be safe.
Yeah. I'm just going to pause here and just let our audience know that we started a little late, so we're going to go a little bit long so that John can answer questions. But I just want to thank everybody. If you need to go, thank you for coming out today. So, okay, supply chain. We've got vaccination rates kind of ticking up in the U.S., but that's not true for the rest of the world, and for all countries in the rest of the world. So what sort of impact, is that having, or will that have?
Yeah, let's be clear about this. There are 3 countries that have handled this thing fairly well: United States, Great Britain, and Israel. These are the countries that are getting, vaccination rates and getting shots in people's arms. Most everybody else is really struggling. We see what's going on in Japan right now with the Olympics and the fact that they're just now approving vaccines, let alone vaccinating people. And yet they're hoping to have the Olympics in a month. We'll see how that goes. But yeah, so we have let's take, for example, the chip problem. Chip problem is really essentially a Japanese problem. That's where the supply chain has broken down. It's mostly because of a plant that burned down more than almost anything else. But the world chip supply was tight prior to that, and it's gotten a little bit tighter. And so there are some special circumstances that have created that. The world supply chain is not back yet. Europe is a big problem. As bad as car price spikes have been in domestic US cars, in the used car market, it's been much worse on European cars. European factories have been shut down for much longer periods of time than American factories have been shut down. And so you take a car company like BMW, you ask the average BMW franchise owner, a dealer, Cars made in the United States, the SUVs, they got tons of them. They're wheeling and dealing. They'll sell those things in a hurry. Cars made in Europe, BMW cars made in Europe, not so much. They have very little supply of those, virtually none on the lots. So yeah, the supply chain in the US is back pretty close to being where it used to be, but internationally that's not the case. And that's part of the problem with lumber, because a lot of our lumber comes from Canada. And so, you know, we've got issues in terms of crossing. NAFTA is not working like it's supposed to work as far as crossing borders are concerned. Yeah, the lumber can come in, but I'm not real sure about that truck driver. So, you know, you've got these issues that are taking place. And some countries, and you know, I'll just single out Canada, still is having problems vaccinating their senior citizens. There are many senior citizens that are still waiting for their vaccine in Canada. They haven't even begun to get to the less than 65 level yet. So I don't see world supply chains getting completely back to normal. They're okay now, but they're not going to get. They're going to be these isolated industries that are going to be still suffering going forward in 2021.
So shifting gears a little bit. So you talked a little bit about the corporate tax rate. I mean, you know, what happens if the corporate tax rate goes to 34%? You know, is really increased, which is something that's been talked about a bit in the political sphere.
I think that I don't know that that's going to happen. I think there's a lot of opposition in the Senate to that, not just from Republicans, but also from Democrats. I'm less concerned about that than I think personal income taxes are probably going to wind up. I think that at the end of the day, I think that there's going to be a compromise on the infrastructure plan. And I'll speak a little bit about that, because about 3 years ago, I talked about infrastructure in one of our presentations, and it is long overdue. I don't think we need 2 trillion of it, but we do have crumbling bridges, roads. We can use some more intra and intercity transportation, et cetera. So there's a lot of infrastructure that can take place. That's, you know, the hard stuff. We can also, it's easy to classify internet access and 5G and et cetera as infrastructure as well. So over 2 trillion, I seriously doubt that's what's going to happen. Somewhere closer to a trillion and a quarter, I think is probably going to take place. And it's going to be an interesting thing as to how they sort that out. There are going to be some new taxes. The Democrats are going to get some new taxes on what they call the rich. I don't think the corporations are going to be subject to the 28% tax. I just don't think that's going anywhere. But I think we're going to pay for that infrastructure through some increases in taxes and some use of already authorized COVID money that is unlikely to be spent. Now that's smoke and mirrors. I'm not real pleased about that, but I do understand that the infrastructure bill on its surface needs to be paid for, or at least appears to be paid for. But remember, that's out over a long period. So in terms of its effect on inflation, I'm not real worried about that one particular bill. But I think we'll have an infrastructure bill going forward. But I think that we will not see corporate income tax increase. We will see a personal income tax increase. I'm not sure about capital gains and dividends. I don't know that we'll see those go up beyond where they are now. They're already higher for higher income people than they are for average folks. But I'm not sure we'll see them go to the full 39.4%.
Got it. So her funding. So what's been the impact of the $5 billion in her funding on our state in particular? And is this, you know, this is sort of, you know, just thinking as a state employee, you know, sort of thinking about this personally, you know, it looks like we've got this $4 billion surplus from this fiscal year. So can you talk just a little bit about that?
Yeah, I think that the impact, a year ago, there was real concern that state and local governments were going to be impacted heavily, but financially by the shutdowns and what was going on. What turns out is not so much. Um, while some people lost their jobs for a certain period of time, I don't want to go back to that slide. But what I showed you was in the second quarter of 2020, yeah, compensation and wages went down, but personal income went up by more than that. So people had the money to spend. Now, did it get to all the right people? The answer is no. There are still people that were, fell through the cracks in some of the programs, whether it was the payroll protection plan or whether it was the enhanced unemployment or stimulus checks. There are people that fell through the cracks. But when you put all those together, people had more money to spend. Personal income went up by $500 million during the recession, the worst quarter of the recession. People had more money to spend, and guess what they did? They spent it. Amazon couldn't keep going. I mean, they were just, I'm sure it was the same at your house, but think back to April and May and the amount of delivery trucks that were rolling up to your house on a regular basis, whether it was food, liquor, beer, or, just hopefully, I think back then toilet paper was a big issue as well. So people were spending money. People were spending money with DoorDash, takeout food, etc. So we didn't see that. And so and not only that, actually the opposite happened because of the tremendous increase that we saw in personal income because of all the stimulus money. State and local governments actually wound up with surpluses that they were wondering, okay, we were telling everybody, look out, we could have a 20% shortfall. And now, whoop, we got about a 20% surplus. What are we going to do with it? So we'll wait and see what the legislators do with it. But the narrative that we had a year ago, and I think I certainly wouldn't have argued about that narrative, was that state and local governments were going to be in trouble. We heard them complaining through the entire year, but when the data come in, we find out not so much.
Got it. So one last thought from one of our participants today. It's a statement and then asks you to sort of reflect on it. So to address raising minimum wage issue and imposing it on businesses, wouldn't it be better to incentivize corporate profit sharing and shifting the tax base a little bit and increasing purchasing power for a bigger pool of people? So their thought was any deficit tax gap could be recovered by slightly increasing indirect taxes like sales taxes. So any thoughts on that idea?
Jennifer, I'm going to go back. This minimum wage is a political issue. It's not an economic issue. Okay, most major companies, Walmart, et cetera, have all gone past $15 an hour, and they didn't do that to be good corporate citizens. They did that to retain workers of quality. And so, the few jobs that are left that are paying below $15. It's not a big deal. We have, by the way, we have historically had a minimum wage in this country for the last, since the Great Depression. So the minimum wage is not new. What we haven't seen is anything happen in the minimum wage in the last 2 decades. And that's why it's stuck at $7.50. But it's one of those, it's one of those minimum wages that's got nothing to do with the market wage. Okay, market wage is so far above the minimum wage right now that no one is being paid the minimum wage. And, it's the market wage is so close in most parts of this country to $15, if not having surpassed $15, that this is just a topic that I don't think it's worth having a discussion about in terms of its impact on inflation, budgets, et cetera, or corporate profits or anything like that. I just don't think that it's relevant given the percentage of the labor force that gets paid below $15. It just isn't going to make it not a material. I think the accountants call it not a material effect. I'll double check with my accounting friends after this presentation.
Thank you, John, and thank you.
My pleasure.
To all of you.
We'll be back to something resembling more normalcy in September.
Yes,
I know. I'm excited about going back to class.
Yes. So speaking of that, we've got a poll coming up for folks to tell us what their thoughts are about getting back in person. But first, I'd just like to suggest that for those of you who are interested in sponsorship opportunities, I talked about that earlier. Belk rsvp@uncc.edu. Just email us and we'll send you more information. And then we've got a slide that will show us a QR code. So to help us in planning future About College events and determine your readiness for getting back in person again, and to give you a chance to win About College gift pack. If you'll scan this QR code and fill out a brief survey, we sure would appreciate it. So that concludes our program today. Please have a safe Memorial Day weekend.